The silver market has just experienced one of the most violent whipsaws in modern financial history. A jaw-dropping 15% intraday swing that's leaving even seasoned traders speechless. And the timing couldn't be more critical as Chinese investors flee positions ahead of the Lunar New Year, creating what analysts are now calling the most massive buy signal in precious metals this decade. Today is Thursday, February 6th, 2026. And what's unfolding in the silver market isn't just another correction, it's a full-blown panic mixed with opportunity. A perfect storm of fear and greed, colliding at speeds that haven't been seen since 1980, when the Hunt brothers tried to corner the silver market and it all came crashing down. Right now, at this very moment, spot silver is whipsawing between $64 and $76 per ounce, carving out price swings so violent that market makers are literally widening their spreads to protect themselves, leaving liquidity completely drained from a market that desperately needs it. The iShares Silver Trust ETF, trading under ticker SLV, closed yesterday at 66.69, down from a high of 109.83 Tau just 8 trading days ago. That's a catastrophic 39% collapse in barely over a week. And yet what's happening right now in Asian trading hours is even more terrifying and more exciting at the same time. Silver just jumped 6.2% in early Asian trading after plummeting towards $64, creating the kind of whipsaw action that destroys amateur traders while seasoned investors recognize it as blood in the streets. The exact moment Baron Rothschild was talking about when he said to buy when there's blood in the streets, even if the blood is your own. The liquidity crunch is so severe that Ola Hansen from Saxo Bank explains market makers are widening spreads exactly when traders need stability most, creating a feedback loop of volatility that feeds on itself like a financial black hole. And what's driving this isn't some abstract macroeconomic theory. It's real people, real money, and real fear manifesting in the most liquid precious metal on Earth. The Lunar New Year connection isn't just correlation, it's causation, and it's massive. Chinese investors, who have been the dominant force in silver speculation throughout 2025 and early 2026, are now liquidating positions en masse as they prepare to celebrate the Year of the Snake, which begins on January 29th, 2026. Zijie Wu from Jinri Futures confirmed what traders on the ground already knew. Longs are stopping out and shorts are taking profits in a cascade that's turning orderly markets into chaos. But here's what makes this absolutely terrifying and potentially the opportunity of a lifetime. This isn't just about Chinese retail investors cashing out for holiday spending. The entire structure of the silver market has been exposed as fundamentally fragile, built on layers of leverage and speculation that looked brilliant when prices were rocketing from under $30 in January 2025 to over $92 in late January 2026, a mind-blowing 146% gain in just 1 year that made silver the best-performing major asset class on the planet. But that performance was built on sand, and now the tide has gone out, revealing exactly who was swimming naked, to use Warren Buffett's famous phrase. Goldman Sachs spelled it out in brutal clarity in their Wednesday note. As prices fell, dealer hedging flipped from buying into strength to selling into weakness. Investor stop-outs were triggered, and losses cascaded through the system like dominoes falling in slow motion. Except there's nothing slow about what's happening right now. The CME Group has raised margin requirements multiple times in the past week, a move that's designed to protect market integrity but has the immediate effect of forcing over-leveraged traders to liquidate positions, adding more selling pressure to a market already drowning in it. Sunil Garg, managing director of Lighthouse Canton, warns that speculator positions haven't been fully flushed out yet, meaning this roller coaster ride isn't over. And while the fundamental case for silver demand remains strong, solar panels, electronics, catalysts, and industrial applications aren't going anywhere. The market needs to cleanse itself of speculation before real price discovery can happen. What makes today's action particularly significant is the growing recognition among serious analysts that this Lunar New Year exit represents a massive buy signal, not despite the volatility, but because of it. The pattern is becoming clear to those watching closely. Chinese speculation fueled the incredible run-up in silver prices throughout 2025, with futures trading in Shanghai and Shenzhen, creating a feedback loop with Western markets that pushed prices to unsustainable levels detached from physical demand fundamentals. Now that speculative wave is crashing back down as Chinese markets prepare to close for the extended Lunar New Year holiday, which typically sees reduced trading volumes and position squaring across Asian markets. But here's the crucial insight that separates sophisticated investors from the herd. This selling pressure is time-limited and forced, not reflective of any fundamental deterioration in silver's long-term value proposition. In fact, the fundamentals have arguably gotten stronger even as prices have collapsed. Global silver supply remains constrained. Industrial demand continues growing, especially from the renewable energy sector, where silver is irreplaceable in solar panel production, and central banks around the world are maintaining policies that favor hard assets over fiat currencies facing inflation pressures. Peter Schiff and other gold bugs have been pointing out that silver's relentless move from under $30 to over $60 through 2025 spoke to genuine tightness in the physical market, not just speculation, and that tightness hasn't gone away just because paper prices are crashing. The paper market, futures and options trading, is experiencing a liquidity crisis and forced liquidation. But the physical market is showing completely different dynamics, with coin dealers from Kansas to California reporting that retail buyers are actually stepping in to buy this dip, recognizing that silver coins and bars at effective prices near $70 represent compelling value compared to where prices were just weeks ago. The comparison to meme stocks isn't entirely unfair, and it's worth examining why market watchers from CNBC to Bloomberg are drawing that parallel. Steve Sosnick, chief strategist at Interactive Brokers, observed that the precious metals theme captured public attention and led to momentum trading that exceeded even the outsized moves seen in speculative assets like GameStop in 2021. There's truth there. Retail investors did pile into silver through ETFs like SLV, pushing trading volumes to levels that dwarfed physical market capacity, and social media platforms were lighting up with silver squeeze talk reminiscent of the Wall Street bets phenomenon that sent GameStop from $20 to $480 in a matter of weeks. But here's the critical difference that bulls are clinging to right now. GameStop was a dying video game retailer with deteriorating fundamentals that happened to have high short interest, making it vulnerable to a short squeeze, but ultimately lacking any real intrinsic value to justify those stratospheric prices. Silver, by contrast, is a monetary metal with 5,000 years of history as money, an industrial commodity with irreplaceable applications in electronics and green energy, and an asset class that typically performs well during periods of currency debasement and financial system stress. The speculation and leverage that pushed silver to $119 in late January was excessive and unsustainable. Absolutely. But underneath that speculative froth is real value, real demand, and real supply constraints that support much higher prices than where silver traded through most of the 2010s and early 2020s. The current crash is washing out the weak hands, the over-leveraged speculators, the momentum traders who bought because price was going up and had no conviction about why. What remains after this purge will be a market built on stronger foundations, and those who can stomach the volatility to buy during this capitulation phase are likely to be rewarded handsomely over the next 12 to 24 months, according to bulls who see this Lunar New Year exit as the cleansing event the market needed. The technical picture is absolutely brutal right now, and traders watching charts are seeing patterns that normally take months to form, happening in days or even hours. Silver broke through multiple support levels that should have held based on historical precedent, blowing right through the 50-day moving average, the 100-day moving average, and even testing the 200-day moving average in a free fall that triggered every algorithmic selling program on Wall Street. The daily chart shows a bearish engulfing pattern that would normally signal more downside to come, and short-term momentum indicators like RSI and MACD are showing extreme oversold conditions that could mean either a bounce is imminent or that the market is in genuine panic mode where normal technical analysis breaks down. But zoom out to the weekly and monthly charts and a different picture emerges. Silver remains in a long-term uptrend that began in March 2020 when COVID lockdowns sparked the beginning of unprecedented monetary stimulus, and the current sell-off looks more like a severe correction within that uptrend rather than the end of the bull market entirely. Pattern traders are noting that silver has a history of violent shakeouts that scare away everyone but the most committed bulls, and those shakeouts often mark the best entry points before the next leg higher. The question every trader and investor is asking themselves right now is whether this is that shakeout moment or whether there's more pain ahead. And honest analysts will admit they don't know for certain, because markets driven by forced liquidation and panic don't follow neat technical patterns. They follow the psychology of fear. And fear is the most powerful force in financial markets, stronger than greed, stronger than logic, stronger than any amount of fundamental analysis. The institutional perspective adds another layer of complexity to this story, because smart money is definitely not all on the same page right now about what silver's collapse means for broader precious metals and alternative assets. Gold has held up significantly better than silver during this sell-off, with spot gold prices around $4,168 per ounce compared to silver's crash, maintaining gold's safe haven status even as silver acts more like a risk asset. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has exploded higher to levels above 65, compared to ratios in the 40s during silver's peak. And historically, when the gold-silver ratio gets stretched to extreme levels, it eventually mean reverts, either through gold falling, silver rising, or both. Strategists at JP Morgan have thrown cold water on precious metals enthusiasm by arguing that Bitcoin looks far more attractive than gold or silver for long-term appreciation, representing a generational shift in how younger investors think about alternative stores of value and inflation hedges. That perspective might be gaining traction in the broader market. Bitcoin has held up relatively well during the precious metals carnage, suggesting some capital is indeed rotating from ancient stores of value into digital alternatives. But precious metals bulls counter that Bitcoin's 15-year history is nothing compared to gold and silver's proven track record across centuries and empires, and that Bitcoin's energy consumption and regulatory uncertainty make it a complement to metals rather than a replacement. JP Morgan separately issued price targets for gold to reach $6,300 per ounce by the end of 2026, driven by continued central bank buying and resource nationalism, a bullish call that implies gold still has 30% upside from current levels, and by extension suggests silver has even more room to run if the historical gold-silver ratio relationships reassert themselves. Meanwhile, Goldman Sachs, traditionally more bearish on precious metals than their competitors, acknowledged in their analysis that Western flows rather than Chinese speculation were behind much of the build-up and unwind, noting that the most violent price moves occurred while Chinese futures markets were closed, which actually argues against the narrative that this is purely a Chinese speculation-driven bubble and suggests the problem is more structural and global. The physical market dynamics are telling a story that's completely at odds with the paper price action, and this divergence is where the buy signal is coming from for those paying attention. Coin dealers across the United States are reporting that retail buyers are lining up to purchase physical silver coins and bars at prices that seemed unthinkable just weeks ago, when silver was pushing toward $120. In Kansas, local coin shops told Cake News that they're seeing a rush of buyers trying to take advantage of the volatility, with customers who missed the initial run-up now seeing this as a second chance to buy silver at a relative discount. The premiums on physical silver, the amount above spot price that dealers charge for coins and bars, have remained elevated even as paper prices crashed, indicating that physical demand is robust even if futures traders are panicking. Reports from Asia show similar patterns, with buyers in India, Thailand, and other markets stepping in to buy jewelry and investment products ahead of Lunar New Year celebrations, treating the price decline as a gift rather than a warning sign. The disconnect between paper and physical markets isn't new in precious metals. It happened during the 2008 financial crisis when gold and silver futures were selling off, but physical products were unavailable at any price. But the divergence right now is particularly stark, and it's raising questions about whether paper price discovery mechanisms like futures markets and ETFs actually reflect true supply and demand fundamentals, or whether they're just capturing speculative positioning and leverage dynamics that have little to do with the underlying metal. If physical buyers are willing to pay premiums above spot price to acquire actual silver, doesn't that tell you the real clearing price is higher than what futures traders are panic selling at? That's the argument bulls are making, and it's gaining traction as the dust begins to settle from this week's chaos. Looking forward, the next few days and weeks will be absolutely critical in determining whether this Lunar New Year sell-off marks the bottom or just the beginning of more pain. The Chinese markets will be closing for the holiday starting January 29th and remaining shut for about a week, which removes a major source of both buying and selling pressure from the global silver market. And the question is whether Western markets can stabilize in their absence, or whether the lack of Chinese liquidity will make volatility even worse. The CME margin hikes will continue putting pressure on over-leveraged traders who need to either post more collateral or liquidate positions, potentially creating more forced selling in the near term before stabilization can occur. Technical analysts are watching key support levels. $70 per ounce is the psychological level many are focused on, with $65 representing a deeper support zone that would correspond to a 50% retracement of the entire 2025 rally. And if those levels break, then $60 or even $55 could come into play before true capitulation is reached. But the flip side is equally important. If silver can hold above $70, and especially if it can reclaim $80, that would signal the selling exhaustion is over and smart money is starting to accumulate, potentially setting up a powerful short squeeze as over-leveraged short sellers rush to cover positions if price starts moving against them. The options market is showing extreme volatility pricing with implied volatility levels that haven't been seen since the 2008 crisis, meaning options traders are expecting continued wild swings, which creates both danger and opportunity depending on how you're positioned. Fundamental analysts are pointing to the fact that silver mining supply remains constrained, with major projects requiring years to bring online. Industrial demand, especially from solar, continues growing, with the green energy transition accelerating globally, and monetary policies remain historically accommodative despite recent Fed tightening talk, all of which argues for higher prices once the speculative excess is cleared. The bear case counters that global growth is slowing, industrial demand could weaken if recession fears materialize, and the dollar could strengthen further if the Fed maintains a hawkish stance, all of which would be headwinds for dollar-denominated commodities like silver. Who's right won't be clear until the picture develops further. But what is clear right now is that this Lunar New Year sell-off has created volatility and opportunity that comes along maybe once or twice a decade. And those who can maintain discipline, manage risk appropriately, and think clearly. While others panic, are likely to find themselves in excellent positions, 6 or 12 months from now, when the history of this moment is written. The psychological aspect of what's happening right now cannot be overstated, because markets are ultimately driven by human emotions amplified through technology and leverage. And the emotions driving silver right now are raw fear mixed with greed, mixed with confusion about what's real and what's speculation. For investors who bought silver at $90 or $100 or even $110, watching their positions lose 30% or 40% or more in a matter of days is absolutely devastating, triggering the kind of panic that makes rational decision-making nearly impossible. And many are capitulating at exactly the wrong time, selling into the crash because they can't stomach the pain anymore. For traders who went short silver, expecting the bubble to pop, they're experiencing the euphoria of being proven right, but also the terror of managing short positions in a market that can gap higher 6% in an hour, as happened this morning in Asian trading, capable of wiping out short profits or even creating losses if the reversal is violent enough. For those sitting on cash, waiting for an entry point, there's paralysis from trying to time the bottom perfectly, knowing that catching a falling knife can be deadly, but also that the best prices are available when things look most frightening. The institutional money managers running billions in commodity funds are facing redemptions from clients who want out of the volatility, forcing them to sell even if they believe in the long-term thesis, creating another source of forced liquidation that has nothing to do with fundamental value. The physical silver stackers, who buy coins and bars for long-term wealth preservation, are simultaneously delighted by lower entry prices and concerned about whether their existing holdings have more downside ahead, creating cognitive dissonance between their long-term conviction and short-term pain. All of these human reactions are colliding in real time, creating the chaotic price action we're witnessing. And understanding the psychology is just as important as understanding the fundamentals or technicals when trying to navigate this environment. As this Thursday, February 6, 2026 unfolds, the silver market remains unsettled, volatile, and absolutely critical to watch for anyone interested in precious metals, commodities, or broader market dynamics, because what's happening in silver has implications far beyond one metal or one asset class. This is a stress test of market structure, liquidity, and the sustainability of speculation-driven rallies in an era of social media and democratized trading. This is a real-time case study in how monetary policy, central bank actions, and currency debasement drive alternative asset demand. This is a reminder that markets can remain irrational longer than you can remain solvent, as Keynes famously said, but also that rationality eventually reasserts itself, often violently. The Lunar New Year exit creating this massive buy signal is the story of the moment. And those who understand what's really happening, forced liquidation of speculative positions ahead of a holiday in the world's largest commodity trading nation, creating temporary dislocation between paper and physical markets that represents opportunity for disciplined investors, are positioning themselves for what could be exceptional returns over the next 12 to 24 months. The alternative scenario, where silver continues grinding lower, taking out support after support until confidence is completely destroyed and the bull market is over, is also possible and must be respected, which is why risk management through proper position sizing, stop losses, and diversification remains absolutely critical. But the balance of evidence right now, looking at physical market strength, fundamental supply-demand dynamics, technical oversold conditions, and the time-limited nature of the Lunar New Year selling pressure, suggests this is more likely a major buying opportunity than the start of a prolonged bear market. And that's the bet many sophisticated investors are making right now. Stepping in while others panic, buying while there's blood in the streets, and positioning for the recovery they believe is coming once this storm passes. The next few weeks will tell us whether they're heroes or fools, but one thing is certain. The silver market in February 2026 will be remembered as one of the most extraordinary periods of volatility and opportunity in modern commodity market history. And those who acted decisively during this moment, one way or another, will have stories to tell for years to come about the week silver whipsawed 15% and the Lunar New Year exit created the buy signal of the decade.